Okay, so welcome to our recorded lecture all about overview of liabilities. Okay, so we have different definition of liabilities here. The first one is it says it's a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of the resources embodying economic benefits. And this is the definition given by the International Accounting Standards, wherein we have to identify or we can say only the liability is there when it arises from past events. When you say past events, those are uh, historical coming from historical transactions or circumstances, and of course the settlement of which will be required an outflow of the resources, okay, from the business. Another definition it says here, liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through transfer of economic benefits, including money, goods, or services. Another definition it says is a final financial obligation of a company that results in the company's future sacrifices of economic benefits to other entities or businesses. So, what basically the definitions mentioned here is saying those are from the previous or past transactions or events, and which you as a business will require outflow of the resources or the economic benefits. Now we have two distinctions of liability. One is current liability and the other one is non-current liability. When you talk about current liability, it says that a liability is classified as current when it can be settled within the normal operating cycle, or it holds the liability primarily for purpose of trading, or the liability is due to be settled within 12 months after the reporting period, or it does not have any unconditional right to defer settlement of liability for at least 12 months after the reporting period. Now, if the liability or liability is not classified amongst this classification here, then it will be treated as non-current liability. All right, provision. Provision is a liability of uncertain timing or amount. So we don't know how much the company will pay or when they will pay it, but there will be probability that they still have to pay or settle this. Now, an obligating event is an event that creates a legal or constructive obligation that results in an entity having no realistic alternative to settling that obligation. So, which means the provisions, especially for the provisions, it doesn't necessarily mean that it should be coming from a legal aspect, but also a constructive one. Okay, so this will be the comparison between legal obligation against constructive obligation. In legal obligation, it derives the obligation from a contract, legislation, or operation of law. While constructive obligation, it came from an established pattern of past practice. So meaning you are accustomed to do it, published policies or sufficiently specific current statement. So which means this is not legally obliged for you to do as a company, but rather you are the one who had obligated yourself to settle this. Okay, the entity has indicated the other parties that will accept certain responsibilities, and as a result, the entity has created a valid expectation on the past of those other parties that it will discharge those responsibilities. So, which means you had that particular published or pattern of practice and published policy that you are obliged to perform certain obligations. Unlike with legal obligation, you are required because there is a law or legislation telling you to do that. Now, if you compare contingent liability against provision, Contingent liability is a possible obligation which also occur or arises from past events, but the existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. So we don't know if it will happen because we have to confirm, or we have to determine that when something will happen or will not happen. And because of this, it is not recognized because it is not probable that outflow of resources embodying economic benefits will be required to settle the obligation. So which means we are not really, or there is not really a possibility or probability that we will pay. Okay, or there is no uh, reliable amount of obligation that we need to settle. Now, provision should be recognized. When you say recognize, it should be journalized. Okay. So when we will need to journalize it, first we have to determine if an entity has a present obligation as a result of past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. So which means we need to pay or we need to settle it using our economic benefits. And then a reliable estimate can be made of the amount of the obligation. When you say reliable estimate, it doesn't mean that it's exactly that it's the amount uh, or there is an uh, accurate amount that you need to settle. As long as the estimate will be reliable, then the amount that we estimated or reliable estimate will be used to record the to record the provision. Now, if these conditions are not met, no provision shall be recognized. Now, contingent liability should not be recognized, but rather it should be seen as a disclosure. Okay. Unless the possibility of outflow is remote, then you don't even need to disclose it. So meaning you can ignore it. Now, measurement of provision, okay, it should be measured at the best estimate. Okay. Now, the question is, what is the best estimate? There are so many discussion about best estimate. We can use expected values or present values or experts' opinion, okay, about measurement of the provision. So, for example, a lawyer or an appraiser saying that this will be the value, they are expert on this, they can then we can use that as a best estimate. All right, thank you for listening and watching my recorded lecture. Hope you learned something.